Okay, today we are going to discuss the framework of regulations that related with the banking sector. So on this regard, we will start with discussing on the issue Basel III and macroprudential regulations. And for your information, sisters and brothers of batch 2019, that the material that I gave to you over the last 4 months basically are related with the test competency that related with the risk management. I think if you check our Instagram, Rifki, have you checked our Instagram, Fikri? Rifki?
Yes, sir.
Last information is Instagram. What did you read? What did you see, Rifki? IPF Instagram. What the information that you got from there, Rifki? Have you seen? Have you known?
Yes, sir.
What's that?
Certification.
Right.
Certification competence.
Right. So the information that I gave you over the 4 months are related with this test competency released by BSMR, Badan Sertifikasi Risk Management, and you will be certified by Indonesian Certification Agency, yeah, level 1. Yeah. So your seniors, Alhamdulillah, took the test competency last 2 weeks, yeah. And from 18 participants, 13 pass. Yeah, so only 5 fails. So it means that more than 70% success. Yeah, and the material that they learn from the test competency are indeed the thing that I gave to you for last semester. Yeah, so actually you taking my class, so you unconsciously are preparing yourself to conduct your test competency next year. So hopefully all of you pass, yeah. And your senior, Alhamdulillah, so far, they have passed the ITP test score, yeah, ITP test competency, yeah, English proficiency. Some of them got 500 plus in terms of ITP TOEFL, yeah, not TOEFL by LTC, but ITP, yeah. And some of them also a success for test competency. So once you have finished from this IPF program, you not only obtain transcript certificate of graduation, but you also obtain certificate of competence and also ITP English score above 500. So indeed, those qualifications are needed for those who are going to pursue for the master degree, PhD degree, scholarship, taking job, searching job, looking for job at the prestigious institution in Indonesia or international. So please always keep your spirit up, and also please do take attention for the course that I give you. So hopefully you will follow the success of your senior next year. Yeah. Okay, thank you for the information. That now I'm going to discuss with you the last topic is about Basel III macroprudential regulation. Then this macroprudential regulation are part and parcel with banking sector's regulation that has been implemented in the case of Bank Central or central bank, and has been followed by some Islamic bank or conventional banks. So Basel III basically refers to the new update of the Basel Accords, yeah, and 1 and 2 that is under development. So Basel III is the continuation of the Basel I and Basel II that relates with the risk management concept in the banking sectors. And the term appeared in the literatures as early as 2005. And the Bank for International Settlement, BIS, itself began referring to these new international regulatory frameworks for the banks as Basel III in September 2010. So the institution that released the Basel III is BIS, Bank for International Settlement, whereby this BIS has committee that accommodate all of the central bank around the world. Yeah. And major changes proposed in the Basel III, actually the quality, consistency, and transparency of the capital base will be raised. So you know that the banking sectors basically happens to be facing some risk. And the risk that majority faced by bank is the called liquidity risk. Yeah, liquidity risk. And this liquidity risk is due to the mismatch happen in the balance sheet. You know that the basic concept of bank is borrow borrow short and lend longs. This is the concept of the banks. Borrow short and lend long. Why borrow short, lend long? Because if the bank got a deposited fund in the short terms, so the payment that the bank paid to the depositors will be cheaper. Yeah, and the lend long, the bank lends long because the longer the bank gives to the entrepreneurs or debtors, yeah, so it will give the bank's returns more interesting and higher. Yeah. So this characteristic of banking sectors will create any mismatch in the balance sheet. Yeah. So this condition requires the bank to have more capital buffer or capital requirement. So in the case of mismatch, they can use the capital that they have in order to back up the mismatch that happening in the banking operations. And the risk coverage of the capital framework will be strengthened. Yeah, again, the capital is strengthened in the Basel III. Previously, the capital is not given a good concern. And a leverage ratio is introduced as supplementary measure to the Basel II risk-based frameworks. So leverage means the numbers, the amount of debt, yeah, backed by assets. Yeah, backed by asset. And a series of measures are introduced to promote the build-up of capital buffers, yeah, in good times that can be drawn upon the period of stress, yeah, reducing procyclicality and promoting countercyclical buffers. So if you remember, procyclicality and countercyclical refers to the business cycles. Yeah, procyclicality means the economy following the cycles up and down. Yeah, up and down, boom and bust. Look like mountains. Yeah, you can imagine the mountains. So up and down, we call as procyclicality behavior. But the countercyclical means that you counteract. So you retain the pro-cyclical behavior in the banking sectors by taking the policies actions. So in this context, you conducted the buffers. Buffers means you retain. Yeah, you retain the flows. Yeah, so that the flows is not going beyond, and they are still in the particular points. Yeah, not go beyond. So this one of the Basel III proposals. And the next one is the risk coverage of the capital frameworks will be strengthened. Yeah. So by raising the capital buffers, backing these exposures, capital buffers means you add more capital in the banking sector. Once you are in the bad condition, the capital buffers will be used, and the way around. And the second one, strengthen the capital requirement for counterparty credit exposures arising from banks derivative, yeah, repo, and securities financing transactions. So again, the capital requirement here as buffers, yeah, in case the bank happens to be mismatched in terms of the balance sheet. And the third one, reduce procyclicality. I don't know whether you understood or not about the procyclicality. In my humble understanding, if you understood about business cycles, procyclicality here relates with the condition of the fluctuation following the cycle, up and down. Yeah, up and down. Look like mountains. Yeah, mountains. Up and down, up and down. So following that one called procyclicality. And the fourth one provides additional incentive to move OTC over the counter derivative contracts to central counterparties such as clearing houses, and provides incentive to strengthen to the risk management of counterparty credit exposures. So it means that the bank tries to mitigate any default risk, yeah, against counterparty exposures. Yeah, so that this one is part and parcel of how to manage the risk. And the next one is about leverage ratio. Is introduced as supplementary measure to the bank Basel II risk-based framework to achieve the following objective. Yeah, the first is build up leverage. Yeah, leverage means the amplitude of the business cycles. So if you remember the business cycle, you know that there is amplitudo. Yeah, the height, the tall, yeah, how much the tall between the bottom and the top. So this called build up leverage. Yeah. Introduce additional safeguard against model risk and measurement errors by supplementing the risk-based measure with a simpler measure that is based on gross exposures. Yeah. And I think all in all, this one is a series of measures introduced to promote the build-up capital buffers. So these capital buffers relate with the procyclicality is if the procyclicality happens, the buffers will be higher. So in the mid of procyclicality, in the mid of economic turbulence or economic down, yeah, so the buffers will be commonly used or frequently used by the banks. But the way around, in the mid of good times, the buffers will be just it is not being used frequently. Yeah. So the function of buffers in this context is one objective of the macroprudential regulation. Yeah, how to maintain the stability of the financial system. Any questions so far? If you have any question, please just interrupt myself. So the next one is about global minimum liquidity standards that I mentioned before. We have liquidity risk. So you need standard liquidity. Yeah, that in this case include the 30 days liquidity coverage ratio. So you only can take your money in the bank after 30 days. So it is called net stable funding ratio. So for the bank instruments, it is it looks like the deposito, yeah, or time deposit. So time deposit is the net stable funding ratio. And the need for the additional capital liquidity and other supervisory measures to reduce the externalities created by systematically important institutions. Yeah. Next one, sisters and brothers, is okay, capital ratio. Yeah. Basel III compared to the Basel II. Yeah. So here is the capital ratio. Yeah. So you have total regulatory capital ratio, Tier 1. Tier 1 is the capital Tier 1. So in the bank we have Tier 1, Tier 2, yeah, layer 1, layer 2, yeah. So this plus capital conservation buffer, countercyclical capital buffer, and capital for systematically important banks. So they have 3 layers here. Capital for conservation buffers, capital for this one, and capital for systematically important banks. So all these capitals are used in order to make the bank safe once the external shock happens from the exogenous variables. And here is the type 1 capital, yeah, the regulatory that the bank used. They have capital ratio 4% and core capital 1 ratio 2% and others here. So this Basel must be maintained by the banks. So the difference here is in Basel III, the capital ratio is upgraded from 4% to 6%. And the Tier 1 capital from 2% to the 4.5%. So the bank requires to have more capital in the balance sheet. Yeah, so this one is the difference. So the difference between the total capital requirement of 8% and Tier 1 required can be met with Tier 2 capital. So more capital are required by the monetary authority. Yeah. So here is the capital conservative buffer. So the capital conservative buffer here different according to the times. Yeah. But the last one is 2.5%. So it means that once the bank got the profits, they have to spend for the capital, the ratio, the proportion is 2.5%. So 2.5% for the profit will be going to capital buffer. Yeah. And another one is the countercyclical capital buffer. So it is used in order to counteract the pro-cyclicality behavior that I mentioned before. So until 2.5%, yeah, of the countercyclical capital buffer. So here is the capital for systematically important banks. Yeah, systematically important banks mean the bank that has systematic risk. So once this bank fail, it will be affecting another bank, such as in the case of Indonesia is Bank Sentry, yeah, that built up by the government last 10 years, yeah, last 10 years. So this banks is required to have more capital for anticipating the systematically important banks. So here is the capital ratios, yeah, 7 until 10%, yeah, plus here and here and here. So the bank will have total capital is around 10.5 until 30% for total capital, yeah, against the asset. Yeah, so quite much. Yeah, so 10% must be proportion as the capital, yeah, from total asset. Yeah. So here is the summary. Yeah. So minimum 4.5, capital 1, yeah, total capital 8%. Conservation buffer, yeah, minimum plus his 1 is the additional buffer, and countercyclical buffer is 1. So the total here is 4.5 plus 1.4, 0, 7 plus 2.5. So at least how much here? 7 plus 7, 40% plus 2.5. About how the reform of the financial system is being made at the moment, yeah, that the authority around the world agreed to have more capital to the banks in order to make them stable in the midst of turbulency. And here is pro-cyclicality and counter-cyclical measures. Yeah, so pro-cyclicality here is the patterns in finance and other economic activities that can pose systemic risk. And financial activity appears especially prone to virtuous and vicious cycles. Yeah, and then the interaction between the financial and economic activity can be mutually reinforcing. They are connected, yeah, reinforcing each other, leading to unsustainable boom and bust. You can imagine the business cycles, yeah. So in the pro-cyclicality booms, yeah, boom is in the midst of economic good economic conditions. In a boom, investors' complacency lowers market risk premium. Complacency means offer, boosting spending and profit that reinforce financial euphoria. Yeah, usually in once the new normal, yeah, the business cycles gradually increasing. It means that going to the economics turbulence. Rising asset prices boost wealth and rise the value of collateral at the moments, making it easier for lenders to overcome the information asymmetries that lead to adverse selection and moral hazard. Yeah, because the economics is going well. So some banking sectors are quite easy to give lending to the people that need money at the moment. Both the value of bank capital and the willingness to leverage this capital rises, increasing credit supply, spurring new economic activity that contribute to the financial euphoria. Rising asset prices also lower the cost of making market, aiding to liquidity and to complacency. So during economic boom, the bank give a lot of money or lending to everybody. Yeah. And the second one is boom to bust. Yeah, the second phase. boom to bust. In the up phase of economic cycle, please imagine economic cycle up and down look like mountains. So in the up phase of economic cycle, price-based measures of asset values rises, price-based measure of risk falls, and competition to grow bank profit increases. During economics boom, most financial institutions spontaneously respond by expanding the balance sheet to take advantage. Yeah, because of good economic condition, the balance sheet of the bank become more flexible, and advantage of the fixed cost of banking franchise and regulation. So they are quite easy. And trying to lower the cost of funding using the short-term funding from the money market. So they are looking for the cheap funds. Yeah. And increasing leverage. Leverage means the ratio of debt over asset increasing. The bank is easy to get money or debts, yeah. And those that do not do so are seen as underutilized in their equity and are punished by the stock market. If they don't do like that, so the stock market will punish them. It means that the value of asset that they obtain is not giving benefit to them, to the banking sectors, I mean. And when the boom ends, yeah, if you can read this one, when the boom ends, asset prices falls. Yeah, the boom ends means if you imagining the mountains, now you are going down. Yeah, you are falling down. When the boom ends, asset prices fall and short-term funding to institutions with impaired and uncertain asset of high leverage dies up. Bank difficult to look for the other sources of fund, forces sales of asset drive up their measured risk, and invariably the boom turns to the bust. So you can imagine that you are in the best condition, and because the economic turbulence, now you are poorer. Yeah, you are less in terms of wealth and asset. Yeah, and the prosperity response of the financial sectors. So with the greater deepening and of financial market and rapid growth of financial wealth, this cycle in both developed and developed countries are increasingly dominated by development in the financial sectors. So we do agree with this. The growing tendency of the financial system to respond pro-cyclicality to impulse emanating from the real economy reinforce expansionary and contractual forces, thereby amplifying swings in investment, output, and employment. Because the economy is turbulence, so they are reinforcing each other. Real sectors are pushing the monetary sectors. Monetary sectors are pushing the real sectors. So they are interacting actively and dynamically at the moment. So because of this reinforcing, yeah, the amplification of the economic turbulence become widened, yeah, so become higher, yeah, the amplifications, yeah, and it will impact to the investment, output, and employment. So another one is financial system is also capable of generating autonomous influences that can result in twists in real economic activities. So it will impact the real sectors. Procyclicality effect of finance and real economic activity derive mainly from procyclical behavior of risk assessment by lenders, investors, that risks are underestimated at time of expansion and overestimated during contraction. So irrational behavior taking place at the moment. So in the midst of good condition, the people trying to borrow more and more, but irrationally, or they are wrongly take the strategy how to productively use the fund. So when the economy going down, they're not able to pay back the money that they are lending before. So increased optimism and sense of security generated by the economic expansion often result in decline in risk, spread and provision, and improve credit rating. Yeah, in the initial place. Yeah. So given the herding behavior means follow behavior. So one the people do it, so another will follow. It called herding behavior. Yeah, herding behavior. Intrinsic in modern capital markets and mark-to-market practices in the valuation of assets and liabilities, this tend to produce a cumulative process of credit expansion. So in the midst of boom, the credit expansion become very massive, yeah, and asset price bubbles and over indebtedness, which in turn add to spending and growth momentum. So it will improve the economics activity, yeah, for in initial phase during the good conditions. Asset prices at such time are driven not so much by improved prospect of income stream and expectation of future price increases, but the price unfortunately is not improved well because the people expect that once the economic boom, it will be economic bust. Yeah, so it is just the factors of future expectations, yeah, of a particular asset. So here we have herd behavior, yeah. So how individual in a group can act together. So you are loyal, yeah, each other, and you are doing together. So it is called herd behavior, herding behavior. And market to market, fair value accounting, yeah, it is also the valuation of the asset once the economic up and down, yeah. And here is the rule of credit markets, yeah, how the credit market here give the impact to the procyclicality, yeah, because procyclicality here refers to the business cycles, business economics conditions. Once the credit become massive, so economic will be upping and down very fast, yeah. So here the rule of credit markets become very important at the moment to make the cycle up and down fastly. And we have now a cyclical downturns. Yeah, cyclical downturns mean the cycles, the cyclus going down. However, at the balance sheet adopts smaller margin of safety, the system develop endogenous regularity or Minsky. Yeah, the cyclical downturn economic activity increased cost of borrowing, income or asset acquired can no longer service the debt incurred. So in the mid of economic downturn, so you no longer have enough money or income or asset to pay back your debt. Yeah. So during the cyclical downturns. So therefore, at the moment that the risk underestimated, yeah. So you don't calculate the risk rationally. So at the end of the day, you will be devolved, yeah, and the amplification of economic contraction become worse. Yeah, because the system fall at the moment because you cannot pay back. So here we have debt deflation. Yeah, the debt deflation as overall level of debt shrinking. Yeah, and credit cycle is the cost of economic cycles. Yeah, so the debt become cheaper and cheaper. But even though the debt is cheaper, you are not able to pay back your debt because you're no longer having income at the moment. Yeah. So in order to respond that one, you have to have counter-cyclical measures. How to make the cycle back to the normal condition or new normal, or at least you maintain the existing cycles become no longer past the turning around points. Yeah. So here called counter-cyclical measures. So against the cyclical tendencies. Yeah. So you are against the cyclical movement, yeah, of business cycles. So in order to that, the cyclicality here needs a capital requirement. So the function of the capital requirement that I mentioned in the initial slide, in order to respond these cyclical conditions. When the cyclical condition is good, the capital is not that much to be prepared. But if the economic is not that good, yeah, so you need more capital to be prepared in order to absorb the risk that could happen once the banking is being shocked, yeah, by other factors, either outside or inside from the banks. So here we have also micro prudential, yeah. So previously you learn about macro. Macro is the great or the big things, yeah, about regulation. But now we have also micro prudential regulations, yeah. So the microprudential here focus only individual variables, individual banking sectors. So the macro previously concerned with the environment where the bank lies in, but the microprudential connected and concerned with the bank itself as individual institutions. Yeah. So the system cannot be made safe by making each bank safe. If you talk about the system, system at large, you cannot just focus on the system at large, but you have to be able to focus on the who that stay inside the system. Yeah. So on this case, this who the one that stay inside the system, it is the banking sectors. Yeah. Therefore, here the microprudential here focus on endogenous risk. Endogenous risk. So here is the another macroeconomic variables. Yeah. So the macroprudential regulation here focus on the macro regulations. Yeah. And related to the financial system stability as a whole. Yeah. Looking at the system as a whole. Yeah. And here also we talk about the costly spillovers, systemic risk. Systemic risk is once the banks fail, it will be systematically affecting another one. So you need to know the common exposure, in order to understand the systemic risk, and also the procyclicality behavior. Yeah. So again, these two things are important. Systemic risk here can be defined the risk that financial stability becomes so widespread that it impairs the functioning of the financial system to the point where economic growth and welfare suffer materially. So it will widespreading, to the other financial institutions. And common exposures here means you have the same exposure, you have the same weaknesses. Yeah. So once you got shocks because you have the same weaknesses, you will fall altogether. Yeah. So it is called common exposure. Yeah. So the macroprudential policy here try to intermediaries or internalize the cost of their behavior. So it means that how to save the financial system, and at the same time how to save the individual variable that stay inside the financial system. This is the aim of macroprudential policy. So here the tools, the tools here is the instruments. In this case, we have so many instruments. Is regulatory capital requirements that I mentioned before, and also they have capital surcharge, so and others, and the next one is regulatory authority problems. Suppose that the regulatory authority considers the systemic risk level to achieve excessive. So the problem somehow is how to make the balance, between the excessive behavior and prudent behavior. So this is the challenge also of the regulatory authorities here, how to make imbalance between the excessive behavior and prudent behavior. Prudence means you don't do anything. Excessive, you do anything. So now how we make it in balance? You keeping your excessive but in prudence manner. This is the challenge. Therefore, in my research, I'm trying to look for the optimal balance. I call it resilience. Inshallah, the book will be launched. I have a book about banking resilience. Once the book launches, I will inform to you. So hopefully you can get benefit from the book launch. About the banking resilience. And here is regulatory authorities programs. So here is estimate aggregate micro data. It looks like how to make a balance from the indexations that I developing now. We have several steps, for example. So we have aggregate micro data. You look for the data. You examine the relationship. You forecasting. You estimate, evaluate the risk. divide the policy decision, you have the interval, yeah, you have the optimal balance, so you have the threshold like that. So and then you are having the acceptable level, so threshold that I mean, and then design regulation that translate macro policy decisions, I mean, into signals. Again, signals. So signals means 0 and 1. Yeah, how you try to make the signals that can be the regulatory concerns when they should take the interventions so that the acceptable level is maintained, yeah, in the midst of vulnerability and shocks. So here is another difficulties, yeah. So how to, here is counter-cyclical, to what extent the counter-cyclical policy must be taken care of, yeah. So it's also the challenge, yeah. And also difficult to accept the notion that despite the fact that they comply with the requirement of the government, and what about the exogenous impose? So it means that we cannot handle the exogenous factors such as pandemic like now, yeah, pandemic, crisis. So somehow they are coming from outside system, beyond our control. So the question is how to adapt and adopt that external shocks. So when the shock coming into the system, so the system is not falling down. So it is the challenge, yeah, the challenge that policymakers are facing now. So who should be in charge of the macroprudential supervision? So all in all, the person in charge is central banks. Therefore, if you learn about the central bank functions and aims, so right now the function has been other than the monetary authority, yeah, also the balance of payment authority, but they have also macroprudential authority, the central bank, yeah. So here another alternative arrangement for macroprudential supervisions, yeah. And you have European Systemic Risk Board, is the authority that beyond or above the central banks, yeah. And central bank under macroprudential regulation, so you can open central bank Bank Indonesia website, and you can see there so many policies that has been taken care of by the central banks as the macroprudential regulations. So the final remarks here is the credibility of regulatory authority in charge of macroprudential regulation is much more important than it is under microprudential regulations, because macro will cover more broadened environments. And regulatory authorities' tasks will inevitably interfere with government and economic policies, since the latter, in general, as financial institutions, do also behave pro-cyclicality. So we are facing pro-cyclicality behavior. But the challenge is how to make this pro-cyclicality is not going beyond or worse, yeah, or making crisis. Delegation of the macroprudential regulation to the central bank may endanger its independence, but this is the right now what's happening. Yeah, that Bank Indonesia is the PIC from the macroprudential regulation. Therefore, a new and sustainable institution structure is capable of establishing the delicate balance. Again, balance among the interested parties is needed. So in the future, if you can understand how to balance between one side and another side, so it is also the great thing that you can give to the policymakers so that they know what should they do and to what extent the policy that must be made. Okay, I think that's all for my side. If you have any questions, perhaps you have any response, feedbacks, most welcome. Any questions so far, sisters and brothers? Clear? Rifki, you have any question, Rifki? Okay.
No, sir.
Okay, clear, yeah? If all clear, then any questions? Okay, if there is no question, then I stop by this chapter, yeah, and you can just refer to these slides, or you can just look the video that I put in the my class, and the material for the test competency 4 will be cover this material. And please don't forget again for your paper submissions on 31st of December, yeah, in my class. Okay, that's all for a while, sisters and brothers. Any other questions before we end all the sessions?
I think no, sir.
Okay, thank you very much, Umran, for your response. Once again, before I end the sessions, I would like to express my thanks and deep appreciation to all of you who have attended all of the sessions over the semester. And hopefully you can get some informations, you are inspired and motivated by the material that I gave. And hopefully you can employ this humble knowledge for your future career or your future uh, uh, dreams. Yeah. And of, for sure, I do apologize if there are some mistake happens during the programs. And hopefully we can meet again and we can discuss again on the next sessions or next semesters or next course. Yeah. And please always keep your spirit up, and please always actively engage in all program that provided by UMY, including IPF. So hopefully you will success and graduate on time with, of course, with great achievements. So you are eligible to maybe continue your activity either for pursuing another degree or looking for another jobs. Yeah, that's all. Perhaps for a while, let's we stop this class by reciting Alhamdulillah together. Alhamdulillah Rabbil Alamin.
Alhamdulillah.
Thank you very much again, Sister Adinda, Sister Rafira, Sister Nana, Sister Fatwa, Brother Rifki, Demas, Burhanuddin, yeah, Umron, Arik, yeah, and others, yeah, who maybe right now could not attend the sessions. Good luck for you. Stay safe and health. Hopefully, we can meet soon physically. With that, Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam. Thank you very
Thank you,
much.
sir.
Very much.
Thank you,
Most
sir.
welcome. Most
Stay
welcome.
safe, sir.
Yes, thank